Good evening, strategic traders, and welcome back once again. This is Brian Swan of Strategic Trading here with you. Now, I know I've been gone a minute, guys, but I'm back, and we've been doing some really interesting things online here, and we are looking at a lot of new wonderful concepts that we're going to be bringing into strategic trading. We're talking about smart contracts with Ethereum. We're talking about going into all kinds of cryptocurrencies. We're talking about making our own peer-to-peer smart contract binary options platform. That's right, Nadex-like platform where real people can go in and write their own options and peer-to-peer based sales. You write an option, somebody gets it or they don't. We put it on the market. That's currently in development along with several other things. But right now what I want to look at, guys, is studying options, traditional options. We've run across several strategies. One which seems to be a favorite of a lot of people is the butterfly strategy, which consists of a bear call and a bull put, which are basically four options. And what you have is, in this situation, we've done the same thing, but we've used Nadex options, and we want to see and test how they perform versus traditional options in this scenario. Uh, the first things that you want to do is you want to have a bull put, which is in a bear call. In this case, we are which would be selling the top and buying at the bottom, which is what we normally do in a butterfly position with Nadex. But there's a different layer of security that they have in this type of option. Now, if we start at the bottom, we're looking at 1740, which in this case has 1742, but the 1740 option we are buying. And we bought that for around $68. We got that for a good deal, but we're looking at around $32 in profit off of that one. At the same time, we're selling the 72 is 1780. Now 1780 gives us about $21 in profit. Now, what we've done is, instead of just leaving those two as is, we've come down to the next strike above and below, and we've done the reverse. So on the 1740 call, we have actually behind it bought the 1720. Now we paid 30. We have $68 at risk on this particular call. The 1740 call. We have $68 at risk, but we stand to make $79 if we get the 1720. So that's about $10 difference in that one. So that's what we're looking on here. And if we're looking at the top one, there's 13 and 21. So that's about $7 difference in there. Now, that's not a lot of money, but what you're looking at is the consistent way, if it's done, if we've done this correctly, a consistent way to make a small amount of profit. And these are called spreads using traditional options. This is the first time that we tried this with binary options, and of course it's a demo, as you can see, because only an idiot would use real money in a demonstration or a test, and that's what demo is for. It's for back testing and trying new ideas and seeing what works and what doesn't work. And anyone who has a problem with demo, like I said, you're a complete idiot. So I have no regard for what you have to say. And so please save your comments and all that. So anyway, so moving on. So we have about 4 hours and 31 minutes to go. And if this fall, now there's one thing I noticed right now off the top with this setup is, looking at this setup right here, you have a dead zone of 20 pips between 1740 and 1720. Also a dead zone between 1780 and 1800. You're looking at a dead zone in this area that if price closes in the middle of these right here, well, you're going to lose both of those options. So automatically I see a problem with that. Now, how does that compare with traditional options? I'm assuming that the time decay will mean that you'll be able to profit on one or the other during the last 30 minutes or so of that. And we're going to see how time decay, how our theta matches up to that. I'm looking right now though, if you look at the prices above here, you're looking at our 1740 and our 1720 strikes, our lower strikes right now. You can see that the one that we've sold, the 1720, is actually picking up steam right now, while the 1740 is still only $15 in the hole. So we're picking up steam here. Our 1780 is clearly in the green, and our 1800 is losing a little bit of steam, but it's at its max right now. So it's at its max. So if we were to lose 13.75 here, and we were to make $21 on the other one, that's a clear $7 profit. But now here's the thing: with Nadex, you have $1 in and $1 out when it comes to transaction costs. So now let's just include these transaction costs in this setup. So we're talking about 4 contracts right here. So that's $8. Let's go again. 1, 2, 3, 4, 5, 6, 7, 8. That's $8 in transaction costs that you will have to run this setup. And we're looking at $7 here, and we're looking at $10 here. So we're looking at $17 minus 8. So we're looking at about $9 profit for this setup if it goes through. And we're looking at a risk zone, which we're in now. But like we said, the time decay will make all the difference. So I'm looking at this as a way to make money on volatility. I'm looking at this as a way not to wait until expiration, but to catch these options on the go, on the up and the down side, and see if we can make a profit on the moves that they make. For example, if you're looking, excuse me, if we look at the Williams percent range on this live trade that we're looking at right now, we are clearly oversold. Okay, we are deep in this range right here that says we should be looking for a reversal. We're looking at a 1-hour chart, which is what I like to use. But also, if you look at our stop and reverse, our PSAR system, the little green dots for y'all who don't know what they are, these are clearly representing a shift in the momentum of the trade, and we're looking at a downward slope on this as well. Now, be it that even though we're looking at a change, if you look at the location of price, this is in the middle of a price range. So even though we are looking at a shift in price and going down, we are technically in what I would call a range bound pattern right here. So until we breach that 1720 level, I wouldn't give that too much credence right now. So we're going to stay and just watch and see what that's for. But once again, do you see how important that um, demo is? How important it is to be able to study these and look at these. I am a student of this. I don't just do this because I like the colors and the numbers to flash around the screen. I do this because I love the entire process of making money this way. And you have to practice and study, just like you have an athlete who goes out every day and plays basketball, plays football, or baseball. He has practice and he studies his craft and he works hard at it. I mean, like the old the old joke, how do you get to Carnegie Hall? Practice. Same thing here, people. So I'm just throwing that out there, and for all you new guys and new people who are struggling with trying to trade and who've lost money, don't give up. Don't quit. And no, this is not beyond you. This is not something that you are going to get tonight or tomorrow or maybe even next year. But like anything else, if you dedicate yourself to it and you practice and you study and you work hard, it will click. I promise you, it will. Now, speaking of clicking, let's look at our numbers up here. Now, we see clearly that we have a break-even scenario on our top binaries, but not really, because once again, we have $4 transaction costs up there. All right. See, that is where they get you at, people. Every example and every trade that you have seen on the internet or through all the webinars, they never include to you the transaction costs. And those are the things that will kill your account. Guaranteed. So we're going to look at that and we'll come back to that and we're going to see how that plays out. And while we're doing that, one of the things that I focused on this week is the long term, long range insurance trade for, in this case, we're using the dollar CAD. Now, yes, this is a demo as well because this is a demonstration. So, what we have here, like I posted in Strategic Trading Group, this is a example that we're using. See if I can find this for unmining Bitcoin over here as well. Let's see if we can find this for you guys here. Well, I don't have it right now, but we are looking at a situation, guys, where we have a insurance trade going on, which looks like the regular old-fashioned butterfly trade, which it is. But we have placed in the middle, we have placed our entry orders for our Forex, which makes all the difference. Now, as I said earlier, we have a insurance trade with a butterfly. And the idea is that to lose money on the option, we have to make as much money or more on the other trade. And that is what we have going on now. Excuse me, y'all. All right. Okay. Now, this is for the week. And we have, in this case, $1,500 up and $1,500 down. All right, so we're looking at making $1,500 in between the two. We're running 7 lots. That is $55 a pip. And we're running about 27 pips up with about 20 pips down. And that is about $1,000 risk. Oh, excuse me, y'all. Sorry about that. We had a small audio delay there, and I'm back. So, what we have going on, my friends, like I said, is a very situation where we're looking at weekly options on Butterfly or CAD. We have 20 contracts up and 20 contracts below. We're running 75 and 25 risk to reward, and that's a total of $1,500 reward and about $1,000 in between the two. And this is for the week. So we are going to see how that plays out for the rest of the week. And I believe that this long term will be the way that we continue to trade the insurance trade, the weekly high level trade with wide strikes and not as heavy of a lot percentage. I mean, 7 lots is a lot, okay? But look at the distance that we have in this. We're talking about, we're at 25.96. And we don't even get into it until we're at 2680, 26 something like that. So we have plenty of range, plenty of time, and most of all, what is different about this trade? If you've been following me and you look at these setups that I have, the difference is clearly here we have stop losses in place. Why? Because this trade is a freaking week long, and there's no way that anyone is going to be able to monitor a trade for 4 days, 4.5 days solid. So put up a stop loss on this. Now, in this case, this stop loss on either side is equal to the full value of the trade should we get it. So you must be careful once your entry is activated. You do not, I repeat, you do not want to let that get away from you. Now, if it does and you're stopped out, you got a break even situation. That's neither good nor bad as long as you don't lose money. But then you must have a game plan for what you would do if you're stopped out. And that is what we'll talk about on the next chapter. So for now, my friends, I want to say thank you all for paying attention and tuning in. I hope that we have sparked your interest. And if you want to know more about what we're doing over strategic trading, especially with Ethereum. If there's anybody out there who considers themselves a master with Ethereum and smart contracts, go ahead and hit me up and let me know what you got going on, and let me bounce some ideas off of you. And hey, like I always say, let's make some money. So, my friends, y'all have a great day, and thank you for tuning in.